our revenue trends, it would be helpful to break it up into three factors. The first factor is what is happening to our unit revenues based on the actions we're taking internally to improve them. We have optimized the network, and 10% of our capacity has been reallocated during this quarter. We have also taken some sales initiatives to improve performance on our distribution channels. And finally, we are ensuring higher connectivity on our international flights. All these factors created a 2 to 3% year-over-year improvement in our unit revenues for the last quarter. And on a steady-state basis, we expect a boost of 5% unit revenue improvement for the next financial year. The second factor is the Jet Airways cessation of service that helped our revenue performance in the last week of February and the whole of March. Overall, for the quarter, we think that the Jet Airways effectively increased our unit revenues by 3 to 4%. Looking forward to the first quarter of 2020, our April revenues have been strongly affected by the Jet Airways shutdown, and in that regard, April revenues have actually been stronger than even March. By May, however, as the industry has added capacity into jet markets, the Jet Airways effect has started to dissipate. And by June, I think the effect will pretty much disappear, except in a few international markets where we overlapped with Jet, as in the Middle East markets. Now that brings us to the third factor, which is the market behavior and pricing discipline. The downside here is that capacity was added rather late in the game without the full benefit of the 90-day booking window. Therefore, the most painful impact is in June in the metro-to-metro markets where close-in fares have come down quite appreciably. Unfortunately, we are also heading into the traditionally weak July-August period, and we are hoping that the new capacity establishes its footing by then. Thus, to summarize, we have an underlying 5% unit revenue improvement trend because of the actions we have taken internally. We have a Jet Airways bump that is pronounced in March and April and largely dissipates by June. And finally, we have a new capacity in high-yield markets that is still trying to find its way around. So we are off to a good start for the first quarter, but I have to emphasize that we have no visibility at this time of the seasonally weak second quarter. The shape of the second quarter will depend a lot on whether the new capacity finds traction in the marketplace and if pricing discipline is maintained. For the quarter ending June 2019 and for the full year of fiscal 2020, we expect that our total capacity will be up by 30%. Looking at our on-time performance for the quarter, our OTP was 76.6%. Our OTP has improved from March onwards, and we have reported an OTP of 90% for each of the months of March and April. We are also very proud of the many awards that we have received during the year, and I would like to thank our 23,000 employees for enabling the airline to expand rapidly, ensure profitability, and simultaneously win all these customer service awards. I'm also pleased to announce that our board of directors has recommended a dividend of 5 rupees per share. I would like to share with the investors our internal discussions as it relates to this announcement of dividend. Ever since the IPO, we've been profitable every year, while this year has just been a break-even year. We think this past year was an anomaly, an aberration, and going forward, we're bullish on our financials. Given the profile of our profitability, past, present, and expected future, we decided that we want to establish ourselves as a company that gives out dividends every year. We realize that having set such expectations, we will of course have to deliver on them. But this management team is indeed resolved to do exactly that. And with that, I'll turn you over to Rohit.
Thank you, Rono, and good evening, everyone. For the quarter ended March 2019, we reported a profit after tax of 5.9 billion rupees with an after-tax profit margin of 7.5%, compared to a profit after tax of 1.2 billion rupees with an after-tax profit margin of 2% during the same period last year. We reported an EBITDA of 22 billion rupees with an EBITDA margin of 27.8% compared to an EBITDA of 11.3 billion rupees with an EBITDA margin of 19.5% during the same period last year. We reported a profit after tax of 1.6 billion rupees for the full year. As Rono mentioned, our profitability was better during the quarter compared to the same period last year, mainly on account of better revenue performance. Our total capacity for the year was 81 billion ASKs, an increase of 27.6% compared to the same period last year. Our total capacity for the fourth quarter was 22.1 billion ASKs, an increase of 29.4% compared to the same period last year. Our revenue from operations in the March quarter was 78.8 billion rupees, an increase of 35.9% over the same period last year. Our other income was 3.8 billion rupees for the quarter. Our RASK for the quarter was 3.63 rupees compared to 3.43 rupees during the same quarter last year, up by 5.9%. This improvement in RASK was primarily driven by higher yields, partially offset by lower load factors. While our yields were up by 12% to 3.7 rupees, our load factors were down by 3 points to 86%. Our CASK for the quarter was 3.35 rupees compared to 3.33 rupees during the same period last year, up by 0.6%. Our CASK excluding fuel was 2.09 rupees in the current quarter, an increase of 6.7% from the same period last year. Excluding the impact of currency depreciation, the increase was 4%, which was primarily driven by an increase in our maintenance cost. Our balance sheet continues to remain strong. Our cash balance at the end of the period was 153 billion rupees, comprising of 61 billion rupees of free cash and 92 billion rupees of restricted cash. Our debt at the end of the period was 24 billion rupees. Before I close my remarks, I would like to mention that we have adopted the new lease accounting standard Ind AS 116 with effect from 1st April 2019. This standard requires us to capitalize our operating leases, and as a result, we will record a lease liability and a corresponding asset associated with these leases on our balance sheet. In our P&L, there will be a reduction in operating lease expense offset by an increase in depreciation and interest expense. I would like to emphasize that while you will see some changes in the balance sheet and P&L as a result of this new accounting standard, nothing changes with respect to the fundamentals of our business or the cash flow that we generate. With this, let me hand it back to Ankur.
Thank you, Rono and Rohit. To answer as many questions as possible, I would like to request that each participant limit themselves to one question and one brief follow-up if needed. And with that, we are ready for the Q&A.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Anshuman Deb from ICICI Securities. Please go ahead.
Yeah, thanks for the opportunity and congratulations for a great set of numbers. My question was regarding the structural improvement measures that you were referring to, which in terms of capacity relocation and higher international share and the sales and distribution mix. So the effect of this would be around 5% for the next year in terms of fare growth. And was that you meant when you said that?
It's not necessarily fare growth, it's unit revenue growth.
Unit revenue.
Fares, yeah, could be fares or load factor, but yes, 5% year-over-year improvement is what we see going forward.
Okay, and my question was regarding the wide-body order, which we kind of contemplated for the international expansion. We have any color on that? Any further details on that?
So wide-body, there's nothing imminent.
Okay.
Are we studying it? Absolutely. But are we about to place an order, or do we see something happening in the near future? No.
Okay, thank you.
Thank you. The next question is from the line of Binay Singh from Morgan Stanley. Please go ahead.
Hi team, thanks for the opportunity. My question is basically we've guided for around a 30% expansion in ASKM. Could you share that, what percentage will go in international and what is the impact of that, positive or negative, to the P&L? Because you're growing quite fast in the international business, so I assume that must be a little bit of a drag on earnings. And similarly, what percentage of that is going to go towards NEOs? Thanks.
So we've consistently said that of the capacity coming forward of 30%, half will be domestic, half international. So half of the 30% goes domestic and the other half goes international. All our new aircraft are coming in on NEOs. So it's all 100% NEOs, which is helping us reduce our costs. And in terms of the international being a drag, we really have an S-curve of profits by market, if you will. And it's got both domestic and international in it. Some of the international traffic is very profitable, higher than some of the domestic profits. So there's no blanket statement of one being more profitable than the other. And the reallocation tries to optimize all that to try and move this S-curve to the right, if you will. So whatever average profitability we have a goal of moving the entire basket of markets to the right, and some of those are domestic, some of those are international. Did that answer your question?
No, yeah, that's quite helpful. So, like in the previous presentations, you've talked about that, when the ASKM growth slows down, the unit profitability will start to improve. So that sort of lever is still left with us, right? Probably 2-3 years down the line when you see ASKM slowing down is where that will kick in.
That is one of the, you're right, that is the accepted wisdom in the industry, that, hey, slower growth is good, higher growth is bad. Fortunately for us, that's not true. We have so many high-profit markets that we are going into that we are very, very excited about them. And there's always a sort of slot issue or a constraint of some kind. And so when we find them, they're actually more profitable than averages. So I wouldn't assume that growth comes at a price of profitability.
Great. That's very helpful. I'll come back in the queue.
Thank you. The next question is from the line of Ronald Dalal from Ambit Capital. Please go ahead.
Yeah, hi. So I have two questions. So my first question is on the international strategy. How do you think that, since you're aggressively growing in international, how do you think that you'll be able to compete with the much stronger balance sheet and experienced players? So what is the strategy there? Because now, so far, we've been focusing on domestic, but now for the last year or so, we are looking to move in international. My second question is on the domestic front. Being the largest player, how do you think fares will behave, given passenger demand is coming down a little bit, capacities are going up? And on the antitrust, if there's any kind of information you can give, because now your market share is near 50%.
Okay. So let me take, you had 2-3 questions there. I'll take one at a time. So the first question is competing internationally with the established players. And I assume you're talking about British Airways, Singapore, Emirates, all of those. They have a very different business model than we do, as you know. They're full-service carriers. They have business class. The economy is a smaller part of the entire cabin. And their cost structure is much higher than ours. So we are a different animal in the market, if you will, and we don't go head-to-head with them, and we are very successful with the business model. So when we fly to Dubai, yes, Emirates is well entrenched, and we are a new player, but we're highly profitable. And we expect that to continue. And if you look at our international expansion, when we talked about the four-corner strategy, we really try and fly the shortest flight to get people into our network. So we really are a low-cost operator, and frankly, our model has proved to be hugely successful to us. There was a second question, I think, on
domestic.
So I have to say, part of our business model is affordable fare. So please don't assume that what's happening here is a lot of fare increases. Of course, with Jet, admittedly, March, April, there was a fare increase. But as I said, by June, it's back down again. So our profitability is not driven by increasing fares. Our profitability is driven by flying into the right markets with a low cost. And then there was a third one about antitrust or market share or something. Look, we are dedicated to building air transportation system in India that's second to none. And that's what we're trying to do, and we don't know where that model takes us in terms of market share. What we do know that we'll be connecting all these tier 2 to tier 2 cities in sort of high-frequency flying so that people can move around more easily. And that's what we're trying to do. Let me give you some examples of that. We know how important tourism is to India. So we are building this Buddhist circuit, now connecting Gaya, Varanasi, and Gorakhpur, which has never been done before. And we're connecting it to both Calcutta and Delhi, and we expect to sort of really boost tourism into those markets. In the Northeast, we are not waiting for the government to tell us to increase flying, but we're taking the cities there like Dimapur, Silchar, Aizawl, Agartala, and we're connecting all those cities to both Calcutta and to Guwahati. And then again, as I said, we're developing a plan to take tier 2 to tier 2 connections without going through the metros. So these are all things that we're doing to improve the transportation system in India. And I hope, the authorities and everyone will see what we're doing and appreciate that.
Sure. And one last thing. So actually, so besides focusing on the passenger revenue and ancillary revenue, what are your views, or is there any thought over the medium to longer term to enter, say, allied businesses, like, say, little bit on, say, airport infrastructure or something where you maybe have some sort of tie-ups with, say, tourism companies or, for example, some booking service companies?
Look, we stick to our knitting. We know what we're doing, we are good at what we do, and we have no plans to sort of expand into other areas that we know very little about.
Sure. Thank you.
Thank you.
Thank you. The next question is from the line of Achal Kumar from HSBC. Please go ahead.
Yeah, hi. Thanks for that, the opportunity. I had three questions, actually, if I may. So one is around the operational challenges. So where are you in terms of your operational challenges on the Pratt & Whitney, on the pilot's problem? And the third one, which is not yet started, is like IFRS 16. So when are you planning to incorporate IFRS 16 into your books of account, and what sort of challenges do you see around that? Second, I wanted to understand about your aircraft financing strategy. Are you still looking at complete sale and leaseback, or is there any change in your aircraft financing strategy? And the last one, I wanted to understand about what's your view on the low-cost business class on the long-haul operations. I mean, I understand that it was in the news that you're thinking about offering low-cost business class seat. Is that true? And then what sort of strategy you are looking around that? Thank you.
Yeah, Wolfgang here. I start with answering the questions on PW and the pilot questions you asked. First on PW, we see a strong improving trend of our performance. Our technical dispatch reliability is 99.85, which is actually comparable, 100% comparable to other engines. A lot of improvements have been achieved in the last 1 year. If you look at, for example, there are always rolling trends of certain parameters of the engine performance, which have, let's say, in terms of in-flight shutdown rate has been reduced by half and is now very, very much below the international standards, required standards. So we are absolutely confident that all these measures which have been initiated by PW show results. For most of the issues, resolutions have been found and are implemented. And we have right now 2 areas where we focus on together with the manufacturers. This is, for one, this is the blades at the third stage of the engine. There is a solution implemented for all deliveries starting, or all deliveries in June it starts. And another area for a gear where we have also expect a solution by September to be implemented. So all these matters are under control. We have no AOGs. We have sufficient spare engines, and so we are absolutely comfortable now how the engine is operating. On the second point, you mentioned the pilots. If you recall, we had a certain pilot. We had a pilot shortage 3-4 months ago. I have to admit that. But in the meantime, we have release about 40 captains every month. In the meantime, we have caught up with sufficient pilots and able and have enough numbers to execute our expansion program. So we are well on track. And looking forward, we also have something like 285 Jet Airways pilots who already joined us, and they will be online within 3 to 6 months. And I expect this number of 285 to increase further. So looking forward, we will have sufficient pilot to execute to support our expansion program.
Great. So this is Rohit. I will address your questions on Accounting Standard 116 and the sale and leaseback question. So first on 116, I think in my prepared remarks I talked about the fact that we have adopted the new standard as of the 1st April, where we are going to our operating leases will be on balance sheet. I'll give you a little bit more color in terms of rough numbers. So roughly we will have a lease liability of approximately 140 billion rupees that will be on our balance sheet, and a corresponding asset of about 130 billion rupees will also be on our balance sheet. So that will be the balance sheet impact. On the P&L side, for the financial year FY20, the coming year, we would expect it to be roughly neutral. The reduction in lease rent expense will be almost exactly offset by the increase in depreciation and interest expense. So P&L impact will be neutral, which is kind of what you would expect. The accounting standard is only trying to bring a liability on the balance sheet. The only other issue that I will point out is that we will be marking the liability to market, and that impact will flow through our P&L. So depending on the change in the exchange rate, the mark to market of the liability will also affect our P&L. So that's 116.
And on the business class issue, we've said repeatedly, I think, that look, airline business really segments itself strongly of less than 6 hours flying and over 6 hours flying. And the less than 6 hours flying, the business model has been tried, tested, and is established everywhere around the world. In the long haul, over 6 hours flying, many people have tried. No one has come up with a good model yet. And I'm not saying we have any of the answers either. So when people say, are you going to do a business class? Are you going to go wide body? Are you going to go long haul? This is very preliminary in our thinking. So we're just putting our thoughts together. So all options are open at this point on that regard.
And so this is Rohit. Just to finish up on 116, there's just one more point I wanted to add. I think most of you on the call are very familiar with the fact that the airline industry for years have analysts and investors have always looked at off-balance sheet debt and estimated an adjusted debt number using different lease capitalization factors. Some people use 5 times rent, some people use 7 times rent, etc. So there's nothing really new with the standard other than it puts it on the balance sheet. I also wanted to address your question on the financing model. So we primarily have been relying on sale and leaseback the sale and leaseback model to finance our planes. Having said that, over the last year and a half, we've signaled that we would like to start owning some planes outright with the cash flow that we generate. We had started buying. I think we own about 12 of our ATRs, which we bought outright with cash. We had planned to buy some A320s, but because of the a little bit of an uncertain financial environment over the last year. I think over the last many calls, I'd explained that we sort of temporarily slowed down our sort of thoughts to buy planes. But as our cash starts building up, it's certainly something that we will utilize some of our cash balance to buy some planes as well.
Okay, Rohit, but what I understand is that I take this very positive, which you said that there is a neutral impact on the P&L other than the forex impact, because generally what I understand is that young leases are penalized more in the initial years, and you have all the young leases, so which are not appreciated. So in the initial year, that should have a more impact on the P&L. I'm not sure if I'm true, but that's what I get from the international airlines and international standards.
Yeah, see, you're absolutely right. The issue is that most of our leases are 6-year leases, and so on average, you'll have our leases that we're capitalizing, which will sort of be on an average life. It's not so. If that would be true if we had if our leases were like 12-year leases, but here this sort of early part of the lease is the first 3 years, and the latter half is the next 3 years, and so because our leases are short term, that's why the effect. You won't see that big an impact.
Okay. Thank you. Thank you so much.
Thank you. The next question is from the line of Sonal Gupta from UBS Securities. Please go ahead.
Hi, good evening. Thanks for taking my question. Could you give us some more insights on the 5% unit revenue improvement that you talked about? I mean, is this going to come because of faster ancillary revenue, cargo growth, etc., or do you see? Because you said this is driven by internal initiatives, right? So
Right. No, look, cargo, ancillary, those are also important areas for us. I would also say that so far we've been handicapped in cargo a little because we are flying routes that are not cargo rich. As we go internationally, we do get more cargo rich. Those are add-ons. Yeah, cargo should do better. Ancillary is the same thing. As you go long haul, people will tend to buy more meals. They will tend to sometimes have 2 meals. So all that are potentials, but I'm not including that in the 5%. We had a project team put together in around December, January, and we said we need to improve our unit revenue and what can we do? And these are the 3 areas we focused on as low-hanging fruit. That doesn't mean that that's all there is going on in the company. Of course not. We've got initiative to improve customer service, initiative to improve cargo, initiative to improve ancillary, as you suggested. Those are not included in the 5%.
Okay. And just another question, if I may, is just on the international slots. I mean, how does that allocation take place? I mean, do you need permission from the say, flying to Middle East or somewhere? Would you?
Absolutely. So there are 2 issues, and they're looked on almost separately. Domestically, you're talking of slots. And it's not just Delhi and Bombay, as people seem to think. There's also can you get a slot in Lucknow or Pune and Goa? Everywhere there's a slot issue. So those are domestic. Then you come to the international flying, and they are governed by bilaterals. So, who has how many bilaterals by country is an issue and who has applied for it. So take Jet. Jet is a good example to focus on. Jet has shut down, and there are a lot of authorities, if you will, that are now available. So several discussions going on with the ministry. Everyone's applying for some of those, but we can't fly them until the ministry approves them. And they'll approve them by saying, okay, Indigo, you get this, and Go Air, you get that. And after they give us the authority, then we have to start the slot process again. Because if they just say that you can fly Mumbai to Hong Kong, doesn't mean you can start flying. You still have to go to the Hong Kong airport and get a slot. You still have to go to the Bombay airport and get a slot. So yeah, for international, it's a 2-step process. First get the bilateral authority, then get the slots at both airports.
And would that require any payments also for international slots, like say to Hong Kong?
No. I mean, if you're going to Heathrow, yeah. But all these others, but they are highly slot constrained, let me tell you. I mean, getting a slot in Hong Kong is not easy. We have some rights that we have not been able to use because we don't have the slots. So these are tough to negotiate and get.
It's not like the slots itself. The airports don't charge you for, but they charge you landing fees. So that's their model is they charge you landing fees.
Sure. So basically, but given that we have a certain fixed number of bilateral flights which are there from India, and say now Jet's allocation obviously going out, so you can get or other people can get those slots. So then you don't need an approval from the other government to fly, right? So you just need approval from the Indian ministry and then negotiate for the slots with the airport.
That is correct.
Okay, great. Thank you so much. I'll join back the queue.